Yeah, so I don't think there's much left of the Volcker rule, frankly. I don't think it provides much of a constraint at all, given the significant loosening that's occurred over the last couple of years. So I do think that there is a case to be made for letting banks dip into their capital and liquidity buffers. So the rules that, as they're designed now, is there's a minimum and there's a supplemental buffer you have. And then there's something called a countercyclical capital buffer that we never used in the U.S. to help make sure there's a nice big cushion of capital to draw down upon in situations like that. So that framework is already built in, and I think it's appropriate for banks to be dipping into those buffers. But they should also be limiting shareholder distributions, too. They shouldn't be doing buybacks. Perhaps they shouldn't be doing dividends as well. If they're going to let those capital levels fall and become much more leveraged as they expand their balance sheets, which we need them to do during the crisis, they also should be really doing everything they can to conserve capital, including limited dividends and certainly executive bonuses. And I know that's not a happy thing for them to do, but we're in a very difficult situation. A lot of people are losing their jobs. We need to make sure the banks are there supporting the economy. They need to conserve capital. If that means giving up some bonuses and buybacks and dividends, that's what it means.
Sheila, you were talking about how we need to protect the American worker above all when thinking about bailouts, when thinking about the airline industry or cruise lines or hotels. I mean, is that feasible right now if we are in this for a long time, months, even into the summer or longer?
I think it's very difficult, and but people are losing their jobs already. And at least provide some access to credit and liquidity directly into those businesses so they can hold on as long as they can, at least, do part-time, keep paying the health insurance premiums. I think those are very important things as well. So, yeah, that is where I would be focusing the effort, because the problem is when you lose these jobs, so frequently they don't come back. And if people can stay employed even at some level with some liquidity help from the Fed, from Congress, and the Treasury, from some combination, I really think that's where we should be focusing right now.
Sheila, I had a question. You mentioned some of the changes you could make to the liquidity buffers, the capital buffers, to try and free up capital for the banks to be able to lend more freely. Realistically, though, are banks going to lend to a company that they think has a chance of going bust? Do we not need to see a further step than that from Treasury or something that allows a government underwriting of certain bonds?
Oh, absolutely. Yes. Yes, absolutely. So I had criticized the Fed up until yesterday for not, kind of containing all their support into the financial system. They opened up a couple of facilities yesterday. One, the primary dealer facility, which accepts broader, different types of collateral, and then their commercial paper facility that non-financial entities can access. So those things are important. Yeah, I think that they should also be providing a facility for businesses of all sizes with, and with loans that can be guaranteed by the Treasury. I think they could do that. They could use kind of the Fed as the administrator. So they would accept the loans as collateral. The Treasury would backstop against defaults on those loans. They could use the banks as intermediaries, but I think that is the kind of thing that's kind of what they're doing in England right now. The larger businesses can borrow directly from the Bank of England. The smaller ones are going through the banks. But yeah, some combination of liquidity provided by the Fed with some backstop by the Treasury against losses, I think would absolutely be a very useful thing for us to be doing right now.